Hi everyone, I'm Brian Forrest. I'm a certified financial planner with Raymond James, a full-service financial advisory firm on Bay Street here in fabulous downtown Toronto. And welcome to Finance 103. It is January of 2009, and today I'm going to talk about how to deal with the economic downturn and the concurrent stock market meltdown. And I am not going to preface this commentary with a detailed explanation of how the world got itself into its current precarious position, because by now I'm sure you're sick of hearing about it. However, I would like to emphasize that we are all in a very sorry state of affairs indeed. The entire world is either in or heading into a recession, and it will not be over anytime soon. The stock market is an absolute mess, and for those of you who don't know, the stock market is a leading indicator, which is to say that as goes the stock market, so goes the economy several months later. Now, to give you an idea of the scale of the downturn, on March 29th of 1999, I was working as a stockbroker with another firm, and I remember a cheer rising up from the assembled brokers as we watched the Dow Jones Industrial Average close above 10,000 for the very first time. Well, here we are 10 years later with the Dow hovering around 8,500 or 1,500 points lower. Talk about a lost decade. From October of 07 to November of 08, the market fell about 50%. In 2008, we have seen all kinds of records broken on the Dow Jones Industrial Average, to the upside as well as to the downside. And this is an index that dates back to 1896, more than 100 years ago. 6 of the 10 all-time highest point losses occurred in 2008. And curiously, 6 of the 10 highest point gains also occurred in 2008. If it's any consolation, only one of the top 10 percentage losses occurred in 2008, and that was on October the 15th, a 7.87% loss. Now contrast this with the all-time one-day percentage loss in Dow Jones history. October the 19th, 1987, Black Monday, when the Dow fell 22.61% in a single day. So, terrible things have been happening, and what do we do and where do we go from here? Well, first of all, absolutely no one can predict how long or how severe this recession is going to be. I spend a lot of time listening to or reading opinion from the various financial pundits out there, and I tend to cringe when I hear one pound his fist on the table and pronounce that this or that is going to happen with absolute certainty. And sometimes they will even assign dates to their predictions. Oil will be at such and such a price by March of 09, or gold will hit $1,500 by November of 2009. Now, there are just far too many variables to make predictions like this. The best you can do is try to assign probabilities. For instance, we can say the probability of oil rising when the economy turns around is quite high, say 90%. And even when making fairly straightforward assessments like this, you should never confuse your own predictions with your sense of self. No investor in history has not made mistakes. It's the nature of the game. And problems begin when you become so vehement about a position that your strategy becomes part of your sense of identity, your sense of self-worth. Reality changes, and every discussion on a particular investment should end with, "I could be wrong." So, as an investor, you have to make some educated guesses, and you're actually going to have to act on your assumptions. Now, if you're the type of person who believes that this is the end of civilization as we know it, then the only place for you is in cash. My own view, and I could be wrong, is that the world will emerge from this downturn in the next year to 18 months, and that the stock market will begin a definitive rise somewhat before then. For the next while, the odds are that we are going to see stocks trade in a range, with the bottom already having been seen this November past. You can't really expect a new bull run in stocks when the economy is in such a mess. But on the other hand, the market has perhaps taken more of a beating than it should have, and some stocks are already grossly undervalued. So what companies tend to do well, or at least hold up during a recession? Typically, we should stay away from consumer stocks because nobody is buying anything. The exception to this rule, or one of the exceptions, is Walmart. All those newly unemployed bankers are not going to be shopping at their shishi-style boutiques anymore. They are going to become Walmart customers because that's the only store that they can now afford to shop at. Walmart will gain market share during a recession, and their stock will most likely rise as it did during the last American recession in 2001. So, what else do people do or not do when they are short cash? Well, they don't eat at restaurants as often. They eat more meals at home, which means they spend more money at the grocery store. Therefore, grocery stores will hold up well in a recession. In Canada, we have Metro or Loblaws, and in the States, there are a variety of choices like Kroger or A&P. Now, speaking of restaurants, although the newly unemployed may not go out to eat that often during a recession, the one place you can afford to eat is McDonald's. In fact, it's possible that a family of 4 can actually eat at McDonald's cheaper than at home. Before mentioning any more actual stocks, I want to emphasize that like any asset, it's not enough to know that a company is doing well or is going to do well. You have to buy in at the right price. For instance, yes, McDonald's is doing well, but here in January of 2009, their stock is trading in the low 60s, considerably higher than their year low in the high 40s, and at this price, expectations of a decent profit are severely curtailed. So what else? Well, governments the world over are planning large expenditures on infrastructure projects as a means to fight unemployment, and thus we are seeing the stocks and firms in this area rising in anticipation of all those juicy government dollars rolling down the highway. Now, the first companies to benefit from infrastructure spending are normally those with engineering arms. You can't build a highway without an engineer laying out the plans first. In Canada, we have already seen these shares in companies like Stantec, Aecon, and SNC-Lavalin make some pretty spectacular advances in the last 6 weeks or so. Now, one other thing to think about. Although everyone hopes to buy assets like stocks or real estate that will rise in value, there is no guarantee of anything rising in a market like this. If sentiment becomes optimistic, we will see the market rise. If not, it will fall or remain stagnant. However, when you own an income-bearing security, like a stock that pays a dividend or a bond that pays interest, you are not relying on market sentiment. You are relying on the strength and character of the company itself to continue to meet its interest obligations or its capacity to pay dividends. Thus, it doesn't matter what the market thinks when it comes to income. Income gets paid whether the mob is in a good mood or a bad mood. Stock prices, on the other hand, are dictated almost entirely by investor sentiment. It's far better to have a secure source of income than to rely on the mood of the market. Thus, when choosing a security, try to own a preponderance of those that produce income. Now, I'm going to continue this session in a separate video, Finance 103B, where I will comment on those two perpetually popular topics, oil and gold, and we'll see you there.